The U.S. Federal Reserve has raised the rates again today. Now, you guys know I'm in Canada, but the United States is the reserve currency of the entire world, and we have to pay attention to it. If the reserve currency of the world was China or if it was England, like back in the old days, we should pay attention to that because no matter what happens, it affects us all over the world. And in Canada, where we are, it makes the cost of living much more expensive, but it makes it great for Americans to come to Canada because their dollar is going up, our dollar is going down. We got a lot to unpack today. We're going to be talking about the policies, how it's going to impact Canadians, how it's going to impact Americans, how it's going to impact property prices and the vulnerable sectors of the economy like commercial real estate and tech, and what we can individually do about it. So let's start unpacking this from what happened today. They have raised the rates 10 times in a row. Now, we have not seen something like this in a very, very, very long time. The rates today went up to 5.25%. Unbelievable, 10 in a row. But if we look at Canada, Canada has only gone up 8 times in a row. If you notice in the chart, there's two zones here where they have paused rates and paused and paused. Both times when they continue to pause the rates, remember when we measure the United States dollar, the world reserve currency, against the other countries, our dollar in Canada goes down as the American dollar goes up. So this is going to cost Canadians a lot of money. How much money, might you ask? Well, we'll check into that in a second and we'll get to that. So if we want to see how the markets actually reacted to this, if you take a look at the 10-year Treasury in the United States, where are we sitting? The 10-year Treasury fell. People did not like what was mentioned today. If we take a look at the 2-year Treasuries, we see that the 2-year Treasuries also slid, also not good. If we look at Canada and we take a look at our 5-year bond rate, if we just look at the 1 day, we can see that in the 1 day, it actually fell off of a cliff once they made that announcement earlier. So yesterday, we were expecting that they would raise 0.25%, and they did, but we can see that the rates even started falling yesterday as well. If we go back to the 5-day chart, you'll see that it started falling earlier on Tuesday once they became pretty sure that they were going to rock those rates. And so what this does is it's going to be lowering down some of your mortgages, but increasing the cost of everything that you're going to be bringing in from another country. So if we want to look at the Canadian dollar and figure out what is the Canadian dollar to US dollar, this has changed quite a bit. If we just look at the last day, we can see that the percentages dropped, right? So this also happens on the DXY when you want to take a look there. This is the version of all the basket of currencies around the world. It's going to make the US dollar stronger than all the others. And so when other countries have to pay their debts, when you have to pay your debts in US dollars, it now becomes more expensive for all the countries of the world that have debt denominated in US dollars. It's going to punish them more. In Canada, we have debt in Canadian dollars, but we import an enormous amount of things into Canada. And now that the US dollar is going to be more expensive, everything is about to get more expensive. This is bad news for people who are trying to get out of inflation and are facing a massive crunch right now. So if we want to take a look at Canada, we can take a look at where we are, that Canada is importing 58 billion dollars. So if you just take that 0.5% that we dropped today and multiply that by that 58 billion, do you know what you end up with? You end up with 2.7 billion dollars. So out of every toaster and every t-shirt and every tie that you buy and every steak, we now have to take that $2.7 billion and divide it among all of those things to make up that money, because that is the percentage that's going to impact you. So though 0.5% just today and another percent yesterday doesn't sound like a lot, when you factor that in over tens of billions, it now really starts affecting people. So that is a good thing to pay attention to. So if we want to see what the United States were talking about today, they released some information, and I think is very important that we always pay attention to. So if you look at the unemployment rate, seasonally adjusted. So we can see that the unemployment, as people are getting more and more squeezed, they're getting a second job, a third job. And you can see that unemployment is sitting very, very, very low, 3.5%, and it's not getting crushed. We have to take a step back here and notice what Jerome Powell keeps talking about. He says that the labor market is too strong and we need a softening of the labor market. They want the number of jobs available to be equal to the number of employees available, 1-to-1 ratio. Right now, we're 50-60% over that number. We have way too many jobs that are available out there for the available workers. This is a problem. And so they're expecting by the end of this year to have 1 million Americans be out of work. Ideally, they would like 2 million Americans out of work to bring the job market into balance. So this is going to be very hard on a lot of people. If we want to take a look here, this is non-farm payroll employment, month over month change. So we can see here, again, these numbers are nowhere near what they're expecting. They're way, way, way too high for them. If you go and look at what they think already is going to be happening for the June meeting, already people are saying 31% chance that they'll leave the rate where it is, 68% chance of that they will raise the rates. But if you continue on, we can see that on another website, their polling is coming in right now. 77% think that they will pause rates where they are. Do I think they're going to pause rates here? I think they're going to pause rates here. It would only make sense to me that they have gotten this far, but they're seeing the cracks in the system. We are seeing banks, one after the other, collapse. The second largest bank in the United States history collapsed just this weekend, and JP Morgan absorbs them and becomes an even bigger behemoth. Now, in the United States, we're used to seeing this happening. Many years ago, we were 14,000 banks in the United States, and now they're sitting something, I think, 4,000 or 5,000 banks. So they have small, medium, and large banks. In Canada, we're not used to this because we have 5 monopoly behemoth banks, and these banks have all the market share. And this is the road that the United States is heading down towards. I mean, back in the day, you would have these medium and small banks that would be nicer to you, give you a bigger loan. Like, how do you get them away from the big guys? We're going to give you a bigger loan, less down payment. We're going to get you more interest in your bank account. And they're going to have to go out the risk curve in order to make more money to try to pay what they're giving you. But this also puts them at a risk because banks under 250 billion are allowed to do whatever they want in the United States. So this is causing all of these cracks, and these interest rates going up is punishing the sectors that are most vulnerable to it. And what are they? They're real estate, primarily commercial real estate, and we'll link the commercial real estate video I did on that. Commercial real estate is the bomb that is going to be going off. In Canada, we have $2 trillion of commercial real estate, and in the United States, we have $20 trillion of commercial real estate, and all of this is going to be coming due when they have to renew their mortgages, and a huge clump of it is going to be coming through between Q3 of this year and Q3 of next year. So there's going to be a lot of these defaults happening. So we have to make sure that we're paying attention to that. Technology companies are getting punished as well. They're in really, really bad shape. So no longer can we have companies that do not produce a profit have these crazy multiples. So if we want to see how the world reacted to that, we could see the S&P 500 was down today. We can see everything is down pretty much, except the VIX was up today. VIX is the fear index. We're not really surprised to see that happening. So in the United States, they usually like to deal with core inflation. Core inflation is when they're going to remove energy and they're going to be removing housing from that. I always get very frustrated when they remove food and fuel out of the mixes. Show me the person that does not use food and does not use fuel. I always say that, what alien are we actually talking about? This doesn't make any sense to us whatsoever. You should be making sure that we're doing a better job at identifying that. But they keep talking about services and, you know, where you go get your hair cut or when you use an Uber or something like that. They want to make sure that that inflation isn't going up, but it's going up. and there's not going to be much they can do to actually slow that down. Wage increases are going up, and if you see where the numbers came out today, it's actually higher than it was at the last reading. This is bad news. So it's going the wrong direction. They're trying to bring that percentage down, and it's actually getting away from them. Remember that Jerome Powell keeps mentioning what happened in the 60s and the 70s, and they are paranoid of making the same mistake because they let off the rate hikes too soon and inflation went bananas. Okay, so let me tell you, by far the largest thing that I hear today is the fact that everybody is asking me, when is the rate going to change? When is the rate going to go back down to where it was to zero? My answer is always like, why? Why do you want to know? I'm curious. And it's not to help them out of payments. That's not the number one answer. The number one answer is they want to go buy. And we're seeing some high value people with massive amounts of cash that are waiting to unleash on the market. Just think for a second, if they actually reverse course and drop the rate down to zero, they would be unleashing not just a tidal wave, like a tsunami of cash at the market, as everyone would be going out and buying things. If that happened, inflation would go bananas, and it would go completely against what they are actually looking for. So this core inflation, I'm surprised to see it, but it's going to be very, very, very sticky. So they gave a meeting today and they released some statements. Interesting things that they mentioned. Job gains have been robust in recent months, and the unemployment rate has remained low. Please remember, this is not a good thing for them. I know that me and you want everybody to have a job, but they're very, very upset at this, that there's a lot of people that have a job. They need what they call a softening of that. So they are saying inflation remains elevated. They're saying that the US economy is much more resilient than they actually thought. Now they got to soothe us, I feel, like a little baby getting put to sleep. The US banking system is sound and resilient, they say. It's kind of hard for us to take that seriously when we saw the second largest bank in their history crumble not just a couple days ago. Also, of note, if we just combine the total losses of the banks that collapsed before, Silicon Valley Bank, Signature Bank, and now we include this one, the First Republic as well, we are now at a greater loss than what we saw in 2008. Please let that sink in a minute. 2008 was absolute mayhem and chaos across the world. We have now surpassed that, and everybody is still saying it's okay. It's okay. At one point, we have to pay attention to this and actually affect how we're going to be doing things. Here is the important point, I think. They mentioned that tighter credit conditions for households and businesses are likely to weigh on economic activity. Tighter credit conditions. Those three words are everything. Tighter credit conditions. So let me tell you this. If banks stop lending money for mortgages, what do you think would happen to the prices of homes? I can already tell you, 80, 90% of people are buying a property with a mortgage. If all banks across the United States and Canada say we're not lending anymore, it's game over. So the freezing up of that, the tightening that they're talking about is happening today. Just a year and a half ago, we were buying commercial properties with 80% mortgage. Today, instead of 20% down, they're asking for 55% down. Who is going to buy a building for $10 million and has $5.5 million to put down? Very few. And this is what's happening. And they want higher and higher credit scores, higher and higher incomes, higher guarantees, higher everything. And so we're already seeing liquidity completely dry up from the system. That is the most important economic indicator for you to pay attention to. So if we continue here, the committee will take into account the cumulative tightening of monetary policy. And notice what they mentioned, the lags at which monetary policy and economic activity and inflation develop. Okay, but this is the big part. The lags in monetary policy. So what is a lag in a monetary policy? You need to know what that is. So just go to Investopedia and just try to look that up. Response lag, also known as impact lag, is the time it takes for monetary and fiscal policy to work. That's what it is. And so notice here, key takeaway. The response lag is the period between the time a monetary or fiscal policy change is implemented and the time the economic impact is felt. Simply put, when the interest rate goes up, how long does it take for you, the citizen or the consumer of the mortgage, how long does it take for you to feel the pain? That's what they want to know. And so if you read this and go down a little bit right here, when the Federal Reserve cuts the federal funds rates, it can take 18 months before there is any evidence of the changes. Did you see that? When they do cuts or raise the rates, either one, it can take 18 months before there is evidence of the changes. This, you guys, is the key to everything. We are not even 18 months from the first interest rate hike that happened. We're not even close. But what about the other 9? We just mentioned the US has raised the rates 10 times. Canada raised it 8 times. We haven't even felt the full effect of the first one yet. So there is a lot more cumulatively that's coming. Like I said, commercial real estate, the biggest problem that's out there isn't going to be hitting until Q3 this year, till Q3 next year. So it's kind of like September or something like that, this year to September next year. It's going to be really, really, really interesting when that happens. So if we want to go and take a look today, how are Americans dealing with this? Well, credit card debt in the United States is hitting an all-time high, almost $1 trillion. This is how America is paying for this. They cannot afford it, so they are paying out of that. What's happening to savings rates? Well, you guys are not going to be surprised to know that savings rates are the lowest that they have been on record. So this is going back to the 60s when they had 10% of your wages were in your savings accounts. And look at where it was when we'd go all the way to 2020. You know, they were sending out checks, people were staying home, saving money, and it went way up, the highest it's ever been. But we can't really count that. But look at what's been happening as they started to raise those interest rates. Down, 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 down. So this is how they are affording to pay for it, is by putting everything on a credit card, number one. Number two, draining all their savings, borrowing from everybody that they can. That is a big problem. And how are we possibly going to get over that? Well, I don't even know. I think that we're in for a very, very, very rough second half of 2023 and a rough 2024. But they're also preparing us for this. When we read their projections, they're mentioning that there should be a recovery late in 24 or 5. They're telling us they don't want to shock the market, that rates are going to be higher for longer than you expect. I know that we all want the rates to go down, but it's probably not going to. So we have to make our choices and make smart investment moves today with the interest rates that we have today. And then anything that comes past that is a cherry on top, is a win. We're having a very tough time in real estate. You guys know that I'm a real estate broker and we specialize in selling properties. So you can always go to some of the websites here. We got a lot of courses that are available for you. But, you know, when it comes to real estate, we have high interest rates right now and high prices. And we're seeing a surge of people that are pouring into the market now because interest rates have gone down. Remember, when you buy a property, you're paying 2 interest rates. The rate that comes directly from the federal government, Canada or the states, and then the individual bank wants to tack on 2% commission on top of that. So let's just say that the central bank, the Federal Reserve in this case, is charging 5%, and then they charge 2% as their commission, and they'll give you the mortgage for 7%. Get what I mean? But what's happening now, the federal government one, Bank of Canada or the Federal Reserve, is not lowering their rates at all, but the commissions are coming down. And the banks are very scared when they see all these other banks collapsing, all their friends are going down. They're nervous about this, so they've reduced the amount of commission. That increases how much the buyers can buy and are approved for. This is the problem that we're running into right now, because we are seeing this every single day as people are lining up for properties. It's bananas right now. You guys know me. I've been saying do not buy over the whole past year. Probably the only realtor online who's been telling people don't buy anything. In fact, I've been saying to sell properties. So where we are right now, it depends where you are and what kind of product. Please don't make the mistake that all real estate is real estate, because those 1 and 2 bedroom condos are doing very well. In fact, the prices are up on those if they're in a good location, good building. But a lot of the other properties across Toronto, millions and millions of homes, are down 20 to 25%. A lot of areas are down 40%, some even 50% down. So it really depends what type of places it is. Not all commercial is good, but industrial manufacturing is doing well. That's one type. Residential is doing well, but commercial is changed forever. We're seeing commercial prices down 40%, 50%. The worst I've seen is down 80%. 80%. Down 80% is not even the cost of the cement it took to build the building. And those loans are coming due. So stay clear. Who owns these big commercial buildings? It's usually REITs, REITs, or it's pension funds. So if you're not invested in the REITs, good, that's great. Like if you had a REIT that was old folks' homes, you're going to do well. But if you had REITs that were towers downtown, that's not going to do so well. If you had a pension fund that owns those REITs, man, you could be into some trouble and your pension could be into some trouble, because how long would it take for them to recuperate that? I don't know. Now, if you're in Canada and the United States, we generally recuperate those. Depends. If we look back in history, 3 to 6 years. But we look at Japan, they haven't recuperated after 30 years. So my point is, you got to move your portfolio around depending on what is happening out in the markets at that present time. I still think it's a great time to be selling your properties if it is high enough. It really, really depends your personal situation. As we look around different areas, there's some areas that are really, really holding true, whereas just a different area code is down 30%, and a few blocks over, their area code now is holding fast and is only down 10%. In that case, that's a property that you might want to sell. If you see a property that's down 40, 50%, that's a property you would want to buy, right? So it really, really depends what type of product. Please don't get hung up on, should I just buy real estate? It's the most dangerous question, in my opinion. And what I'm seeing is real estate is the biggest thing that's going to make you free financially and to set your family up financially. And everybody I speak to, the number one thing that they say is, I can't get that property here. They all want to be within a couple blocks of their property. Please don't think that way. You could buy an hour away, 2 hours away. If you've already done that, maybe you want to expand to your state or province in Canada. If you have already done that, maybe you want to start looking at out of state. If you've done that, think of another country, because the more you think larger, the more it's going to become clear to you that you can make a lot of money this way. And if you've been property managing your properties, I don't think you should be doing that. I think you have a lot of great opportunities if you let the other professionals do that, and you do what you do best, is buying properties at good deals, locking them up and renting them out. Anyway, guys, this is going to have profound impacts, obviously, in the United States, as all car loans, all mortgages, all credit cards, those rates are going to go up. In Canada, because we import so many things in US dollars, our costs are going up. So when the Central Bank of Canada, for example, does not raise rates, it saves us a couple dollars on a mortgage, right? But now the dollars that we just saved, we have to go spend to buy all the things that we're importing from the United States. So at the end of the day, it just evens itself out. So as much as it looks great from the United States to look at Canada, it's not very good. For Canadians who want to travel down to the United States, it's even more expensive, not very good. For Americans to come to Canada, it's amazing. For them to buy properties here, to invest here, to come visit here, it is amazing for them because their dollar goes so much farther. So this is really an international community. This is why I love this channel. We have a lot of Americans, Canadians, people in Europe, and they talk among them. Please leave comments below. I try to read all of them. I get back to the ones that I can. I want you guys to keep on crushing. Honestly, we have not seen happen since 2008. And so this is why I urge caution. And it's very hard to say, because some people say, should I sell my property? We talk to people all the time that they've owned their property for 30 years. And they said, I have no intention of moving here for another 30 years. Cool. Stay exactly where you are. But when you talk to somebody who is like, David, I just retired 2 months ago. This house is all I have for my retirement. If it goes down anymore, I'm not going to be able to afford to live. And say you were in a very, very expensive area where properties are dropping drastically. I mean, you guys got to be able to see the writing on the wall. It would be a time to sell a property like that. Anyway, you guys, I wish you guys the very best. As always, I want you to continue crushing it. That's why I make videos like this. I want you to be safe. The next 2 years is going to dictate the next 2 decades of your life. Please follow me on YouTube, on TikTok. We really appreciate it. And I hope that this is giving you value. If I did give you any value, please consider subscribing, and I'll talk to you guys soon.